So welcome back for our second session today. And I see most of you are in our first session. Thank you for coming back. As we've noted yesterday, our focus of XTC is on building strong, successful, scalable commercial enterprises by whatever means necessary within ethics, of course. Now, that may be bootstrapping, that can be getting a strong tranche of investment from private venture capital partnerships, which Simon Lancaster discussed yesterday. That can be through corporate collaborations, such as what NXP's Lars Rieger discussed yesterday. And another variation of the sort of a combination of those two is a different flavor of VC, which is not the private partnerships, but what we were discussing offline a minute ago, funds run by large corporations that are known as CVC, or corporate venture capital. This was a relatively new concept even 10 years ago, but now there's hardly any major corporation that doesn't have a venture fund, from General Motors to Airbus to BASF and Verizon to John Deere tractors to pharmaceutical companies, and also, as you heard offline, Samsung Electronics, where our own scale-up of XTC began in 2019. So today, to discuss the unique aspects of engaging with corporate VCs, we're pleased to bring back Jonathan Charles, who it's hard for me to relate to the calculation, but he has now spent over a decade with the Catalyst Venture Fund of Samsung, where he worked with XTC founder and chair Young Sohn on a wide array of deep tech investments, and was part of Young's team, in which I was also included, that was responsible for the scale-up of XTC at the turn of the decade. And he's done prior boot camps for us. Recently, as he mentioned, Catalyst Fund has narrowed its focus more tightly around compute, memory, storage, and networking startups and innovation as they relate to semiconductors and cloud edge infrastructure. But his previous experience has covered just about the full spectrum of XTC's domain. So almost everything that the folks on the call are doing. So Jonathan, whom everyone refers to as JC, welcome. He has an ideal perspective to help startups successfully engage with corporate venture capital. Welcome back to Bootcamp.
Great, thanks, John, and so good to see you again.
I will stop share and let you get to your slides.
Yeah, let me just do that real quick here. And thanks for the invite today. It's a pleasure to spend time with you once again. Let me just get my slides set up here. And yeah, so today I think what we'll do is we'll spend, like John mentioned, some time about how to successfully engage, with corporate venture capitalists. And I threw together some slides here for everybody, mainly as kind of a guide for our discussion. And it's a sort of a list of just some of the basics. So for those of you that already know how to engage with corporate venture capitalists, this may frankly be a little bit kind of too simplistic for you. Think of this as sort of like a quick, down and dirty corporate venture capital, entry level class, 101 in less than an hour. I've also added some items that I call level up, which are sort of based on observations I've made over the last 10 plus years. Think of them as like pro tips, things that you may not read about online, that are maybe a little bit more difficult to sort of grasp if you're new to the corporate venture capital world. And with that, let's just jump right into it. So the first thing is, will the real strategic CVC please stand up? And I'm being a little cheeky here, but from the get-go, you want to understand the nature of the corporate, the CVC that you're interfacing with, or a group of CVCs that you may interface with, because they come in different flavors at first glance, but in reality, I would argue, and this is a little bit debatable, if I was in a room with 10 CVCs, there may be a healthy debate about this. Ultimately, they all end up being kind of the same, and I'll get to exactly what I'm talking about. So on the left there, the first is the strategic CVC, and what makes them strategic? Well, you have to ask yourself, why is this CVC even making investments? Is it to help out their business units, which I would argue is usually the case for the vast majority of CVCs, or are they just trying to make a return on investment? I have personally come across CVCs that claim that they are, quote, financial CVCs. And then I dig a little bit deeper and I go through my network and I find out, yeah, well, that's really not quite the case. There are, of course, exceptions. And there are also CVCs that sort of change their strategy every couple of years. And then the last one, D there, you'll see at the bottom of the list, I call the newbie CVCs, which are teams that are generally new to the market. They typically don't lead deals. And you probably should be able to pick up pretty quickly that they're, at least for the time being, sort of going along with whoever's leading in the rest of the syndicate. I'll talk more about syndicate in some follow-up slides here. Ultimately, at the end of the day, if you look at the right-hand side and you think about leveling up, let's go through a quick list, and then I'll return to the types of the CVCs at the bottom bullet point on the right-hand side. So just a quick note to level set with everybody, pre-seed is typically too early for typical CVCs. However, seed level deals actually do work for quite a few CVCs. Like our team, for example, has done seed investments going back over 10 years. Not as many as other investments we make, but seed can definitely be on the table. We're a deep tech fund, so if an early on team shows indications from a technology perspective that they have something that's truly innovative, then it's okay for us to go, that early. That may or may not apply for other funds. Another thing to learn, if you think about leveling up, is some CVCs actually do what we call invest to learn. So think about a company, say the one I work at, Samsung, right? We make everything from washing machines to cell phones to memory chips and a whole bunch of other products. But, we don't make quantum computers. So in the past, we actually invested in the quantum space to invest and learn. And boy, did we learn a lot about quantum computing. So we basically increased our IQ, our intelligence around areas where, frankly, we didn't know much. So sometimes, the CVCs that you're talking to, particularly, I think if you're on the deep techie side, or if you're in a new market that the CVC is just not affiliated with, it's possible that they may be investing strategically to increase IQ. When you're going through the process of thinking through, okay, what types of CVCs should I be talking to? Ultimately, what you want to get to is on the left-hand side, you'll see the strategic CVC. What makes them strategic? Typically because they're investing to enhance something about their business units. Maybe you've got a new technology or an access to a new market or channel, or theoretically you could fit it into a suite of portfolio of products that would be good for the business unit. Okay, so the CVC is exclusively strategic, but what is the process of engaging with those business unit people? For most of these big giant companies, there's no phone number to call for a specific business unit, or certainly a business unit head. And particularly for international companies, big tech companies like Samsung and others from Asia and other parts of the world, from Europe, it's really hard for people in the West to sort of penetrate those companies. There may be language barriers, other communications barriers. So you need to understand, as quick as you can, okay, if you're a strategic CVC, how do we engage with the business units? What is the process? What is the purpose? And then ultimately the next bullet down, how do we get to the investment committee? How do you have those CVCs basically hold your hand through the whole process to ultimately get to a win-win with an investment, and then any potential collaboration after that? One note, which is kind of seems tactical, but the second to last bullet on the right, CVCs will scrutinize financial models. There seems to be some misconceptions that, if it's all about business units and collaboration, then all the other sort of typical VC due diligence activities are somehow lessened. I would argue that is absolutely not the case. And so you should always be ready to do, full diligence, just like you would with a financially orientated traditional VC. And ultimately, again, just to kind of recap, it's really about understanding the motivation. So, why should you care? A CVC is strategic or financial, or they change their mind every couple of years. It's really about motivations, right? The motivations, call it their strategy, actually influences the processes and the decisions, right? So a simple example might be, let's say they make an investment and a couple of years down the road, there's an opportunity to sell the company. And maybe different people on the board and the founders have disagreements about this. on what the strategy should be on exiting the company, and primarily when to exit. Sometimes founders want to take it even further, build more value creation. Financial investors may have their incentives to exit quickly so they can show a return. It could be all over the place. And you'll be in a better position if you understand everybody's motivations, right? And a CVC's motivation is tied to the style or A, B, C, D on the left. What type of CVC are they? Next one. Oh, my CVC, wherefore art thou? A little play on some words from Shakespeare. So what this is really about is, and it seems pretty basic, but there's some nuances here. How do we even find those CVCs, right? Okay, I'm this kind of startup with this kind of technology for these kind of markets. Who's a good fit for me? How do I even find out? Well, some of this will sound obvious, but what's interesting is, I don't think it's so obvious because I get hit by false positives all the time, and I'll get to that in a second. So, you can look at the CVC's websites, don't forget their portfolio pages. They'll list out the entire portfolio typically. Usually there's a strategy page. It's a goldmine of information. There are quite a few CVC reports out there. CV Insights comes to mind. I think they do a CVC report every, call it 18 to 24 months or so. The next one is obvious, but the reason why is not as obvious. So, you look up all the team members' profiles on LinkedIn. You can see mine on LinkedIn, for example. It's, I think, fairly comprehensive, although I do need to update it. But what you're really getting at there is what types of people are on the team. Are they business unit people? Are they professional investors like me? I mean, this is what I trained for many, many years, and it took a while to get here, but now I'm a professional investor on a CVC team, and this is all I'm going to do for the rest of my life. Are there some entrepreneurs on the team or former entrepreneurs, or is it a mix of people? These kind of things are really interesting and are sort of indicative on how the team will operate. I will tell you for a fact that when our fund, for example, was created under Young Sohn, all the senior executives on our CVC team had come from private firms on Sand Hill Road. So if they were all from private Sand Hill Road traditional VC firms, how do you think that influenced our culture and our processes and our frankly, our thought processes, to be very specific? We had a very strong flavor, particularly on the path to investment committee, of acting like traditional VCs. And from a training perspective, as the first associate and the new guy on the team over 10 years ago, this was super helpful. And then that translated in me being able to be even more helpful for the entrepreneurs in the context of a corporate venture capitalist. You can also look up funding press releases from similar companies to your company to see, who were the investors in that company. And by the way, there are all sorts of databases out there like PitchBook, CV Insights, even some kind of free ones, Crunchbase, whatever. They have different levels of quality, so I didn't really put them here. And you'll have to be the judge on, can you get access to those somehow, pay for it, use your friend's access, whatever. So just, you could be the judge on which database you want to use. I don't want to sort of advocate for this database or that database. There's a couple that I like and there's a couple that I don't like, but just be aware that they are out there if you've never seen one before. And then finally, this probably should have been A, because this is probably the best one, word of mouth, right? If you get introduced to a CVC from somebody who also knows that CVC, and in particular, if they worked with them before, that has multiple bonus points across multiple dimensions. Think of it as everybody's in a sense validating everybody else, and we call that a warm introduction. That's the last bullet point on the right hand side, and that's always super valuable, is to just get introduced from somebody you trust that is also trusted in turn. And let's just level up here. I've already touched a couple of these points, but let me go through them real quickly. Your time is extremely precious, right? If you think about early stage startups, what is the one thing you have assuming you don't have $100 million in the checking account from the last round, because by definition, you would be a much older company. You've got 24 hours in a day to execute. And let me tell you, and this is a little bit of a translation of a pet peeve of mine, I get pinged all the time by entrepreneurs that are making very rapid assumptions on what I'm looking for, despite what it says on our company website and despite what it says on LinkedIn. So it's almost comical in a sense. Like, I get pinged by gaming entrepreneurs all the time, for example, because they make the assumption that because I work at Samsung and we make mobile phones, I therefore invest in mobile gaming apps. Can anybody see anywhere on our website or my LinkedIn profile, do I even use the word gaming at all? I never have, and I never will, because that's not what we invest in. So then they ping me about this. So they've wasted their time, which is more important than my time, making this effort, because I know they're also pinging other people as well. And then sometimes they'll even follow up when I politely decline, and they'll say, hey, can you introduce me to somebody else? Well, people need to understand that just like everybody else in society, a venture capitalist has what's called political capital, right? If I make an introduction to friends of mine, even if I think this company might be in their sweet spot, I can't make that introduction, because what if it turns out, I don't know this person, right? They're just like pinging me on LinkedIn. What if it turns out that this team doesn't have their act together, they're not competitive? There's 8 million reasons why they may not be a fit for a friend of mine who is a gaming VC. So I have to fully understand a startup before I can make that warm intro, right? And but it's not my job to understand gaming startups in this sort of example. So I would be very careful about asking people you don't know to make introductions to other people that you also don't know. And nobody in this situation knows anybody. And it's not a warm introduction, right? It's just an awkward situation. And it's something that people don't talk about all that much because it is awkward. But, I'm just throwing it out there that, it's really about wasting your own time, and you've got better things to do. You've got to build value and build a company, right? And so I would focus on that, and then focus on research-based targeting and find those CVCs. And then if you can, get the warm introduction to the right CVCs. Couple other things, portfolio companies that are listed on websites, they don't always have the why did we invest. Sometimes they do if you're lucky, but that's certainly something you should ask about, earlier rather than later. The good news is there is a lot of information out there, but it's also, in a sense, too much information, and you sort of have to do a little bit of your own research and to get to the right people through the right people. So I think enough said on that one. Number 3, we're going back to the basics and then some. So this is basically a laundry list of sort of the details around how does a CVC do what they do? How is it important to me, the entrepreneur? And basically, it's knowing the landscape of how do you work with a CVC, both from the financing perspective, but also this leads to things like the collaboration perspective that I talked about earlier for strategic CVCs. So you've seen lists like this before, right? These apply to financial traditional VCs as well. What's the source and the size of the CVC funds? This is very tied to the strategic nature. Most CVCs basically work off balance sheet from the mothership, from their headquarters. Sometimes their funds will be set up individually as separate legal entities. That has a different dynamic where the fund may actually, over time, basically use up all their capital, and then there are issues around, well, can you join my follow-on rounds and all that kind of stuff. So just be aware and ask questions around, how is your fund structured? That sort of is a really good indication of the CVC's financial strategy. Can a CVC lead? Do they follow? Does it just depend on the situation? What's the check size? Very important. What's the check size, not only per round, but over the life cycle? So for example, some CVCs may say, hey, we could do 3 million in this round, but over additional rounds, when we do pro rata and so forth and so on over time, they may actually get tapped out at some dollar figure. And you need to understand that early on, because you need to be thinking about your financial planning, years ahead, actually. Syndicate tolerance. So this is probably a phrase you haven't seen before, but what this means is, does the CVC play nice in the playground with other CVCs? So the good news is 99% of the time they do. You might actually be surprised. When I think about working on the team I'm on now for the last 10 years, you'd be amazed at how we totally play nice in the sandbox with other semiconductor companies. One might assume that we don't, but we actually do. But one thing I have learned over the years is sometimes there are some CVCs that get a little uncomfortable, particularly if there's board participation with other CVCs that are considered sort of competitive to them. Yeah, this is not a situation that happens too common, where the entrepreneur is therefore forced to make a choice between this CVC or that CVC. I'm sure it happens. But you might want to casually ask about this sort of sensitive topic. So just be aware that for a CVC, that's an issue. On the traditional CVC side, yeah, they're all competing with each other, right? And you might even be able to find articles about different feuds on that side of the fence between various CVCs, kind of like VC gossip, right? So I won't touch that one too much, but rest assured, when financial VCs are trying to make a return, yeah, they're competing hard. Market deal terms, marketing quotes. So if this is your first startup, when you're working with your lawyers, they'll use a term called market, which are, what are commonly accepted deal terms, right? For 13 years, we had quite a bull run. Let's just be honest here, right? And terms got market in a way that was extremely entrepreneur friendly. And for a variety of reasons, which are kind of beyond the scope of just 1 hour with you here today, the pendulum started swinging a little bit starting last year, and the funding environment's become very tough. So you might expect that market terms have shifted to be a little more investor friendly. But the question we have now, given particularly the macroeconomic situation, there's a situation in Ukraine, there's a situation in Asia, there's different opinions on how the global economy is doing. This all trickles down ultimately to startup funding. It's all connected, really. That's a simple way to say it. So now the question is, in a world of great change, how far is that pendulum going to swing the other way? Work closely with your counsel on what is market. By the way, on this point, some of the big law firms in Silicon Valley, Wilson Sonsini, Fenwick, Oric, they actually put out various quarterly reports on deal terms that they are seeing. And that is market. You can actually look up and see like 75th percentile, 50th percentile, top percentile. Here's one: liquidation preferences, right? For many, many years, it was basically one, right? If you went way back in time to the 90s, there were some pretty ridiculous liquidation preferences. Now the question is, will they increase? Will that pendulum swing? And what is considered market? And basically, if some investors are being too aggressive and they're not market, maybe don't take that term sheet. But you, of course, have to balance that on or balance that against what is the funding environment like. It's really supply and demand, right? To put it simply. And things have changed relative to the last 13 years, right? So maybe I'm pointing out the obvious, but definitely if you're new to startups, understand what is market. Does a CVC, how do they think about board participation? Lots of CVCs will only take a board observer seat, which, by the way, is often a requirement of their investment. They may not take a full board member seat, mainly due to liability reasons upon advice of their own counsel. That's like a whole nother ball of wax that we probably don't have time to get into. And it's kind of out of scope anyways. But just going into a potential investment situation with the CVC, it's good to understand early on if they're looking for that full board member seat, board observer, or they don't even care and they don't want to be on the board for whatever reason. Ties to commercial agreements. So this is an interesting one that is obviously tied to if a CVC is strategic or not. will they require upfront as a part of the investment some sort of commercial agreement? So my team actually has never done that historically. There were times where we saw that our business units expressed such strong interest up front that we actually did put together some commercial agreements sort of tied to the investment. But it wasn't like, if you don't do this, you don't get that. This may be the case for other CVCs. It's sort of like a case-by-case analysis. Some CVCs don't require any commercial agreements. Some do it sometimes. Others are all about that, right? So you just need to understand that upfront with the CVCs that you're working with. I already kind of talked about investment committee a couple of times. The motivations on the processes to get to investment committee are super important. I talked about that before, just to recap. But one thing to understand is you want to understand who's on the investment committee. Is it the head of the CVC fund? Typically, that's the case. They make the argument, usually with deal team members at the investment committee. But what's really interesting and really good to understand is it the CEO of the company? Is it the CTO? Let me tell you, if the CTO of the company is on the investment committee, that probably means it's very tied to what the business units are doing. And the CTO wants to be aware of new products, new innovation. How does it fit into the jigsaw puzzle of the CVC or the mothership's product suite, right? That's a real good tell that they're actually truly strategic and they're really interested in collaboration, right? So you need to understand not only the process of getting to the investment committee, but who's on the investment committee. Regulatory issues. This is one that is not well understood or written about online. A lot of CVCs, particularly if they're international, but also domestic ones as well, actually have a lot of regulatory reporting. So they may have deal term requests about things like financial reporting, right? And so every time the company I work for makes an investment, we have two big regulatory issues. Number one is called CFIUS, again, out of the scope of this, but basically the simple version is when an American-based startup takes international money, there's actually a government filing, a US government filing that you have to go through, and it's particularly relevant for deep tech companies. So we need to work with the entrepreneurs up front to understand that, there may be a little bit of extra work here around CFIUS regulations for us to make an investment. Sometimes the analysis shows that we don't actually have to do a filing with the government. Sometimes it shows that we do. The point that I'm making here is that it requires some bandwidth from the entrepreneurs, and everybody should understand that up front. Other things are actually not as complicated, but they sound a little weird at first. But we have some deal terms that say, hey, we need some information rights, no matter how many shares we hold in the company, only for the purpose of reporting back to the regulators in the home country of our parent company. And at first it sounds kind of weird because maybe entrepreneurs haven't heard that before. And they're like, why do you need all our financial information? It's pretty simple. We just need a cap table. We need to show who's on your team. And we need to show, that the company is basically real. And that's expressed through not only their corporate filings, but their quarterly financials. And then people on our regulatory team take that information, they package it up, and they report it to the appropriate regulators in the home country. It's not a complicated thing. It's when I work on it every quarter, it's super fast and everybody's happy and we just go on business as usual, right? But you should be aware of these issues up front so you're not caught off guard and you're like, hey, you guys never told me about that, right? That you need these information rights or whatever. So I bring that one up specifically because it's not written about a lot. And of course, there are many articles about this out there online, but what else can the CVC bring to bear, right? Ideally, you're working with the CVC because you want to get your technology into the platform of the mothership of that CVC. You want to get into their product suite. Maybe they even resell your product. There's a lot of different combinations here. But what else does the CVC team bring to you? Do they have ecosystem people? Meaning, do they have people that help you with, there's all kinds of things, right? Recruiting, marketing, business development. all sorts of stuff. So what else can the CVC bring? You be the judge of that. If we want to level up, here's a couple of just observations and things that are good to know about. Sometimes, and this is counterintuitive, CVCs can actually lead with a smaller check. Financial VCs don't understand this at all, but I've led a $60 million round with a $5 million check. Oh, how could I do that? Well, it was because it was in the memory and storage space. And the company I work for is the #1 leader in memory technology by number of unit shipments. And one would argue also by advanced technology. So we're a major player in that space. And the entrepreneurs were very comfortable working with us because even though we had a smaller check, because we're punch out of our weight class, or actually we are the gorilla in that category, to be honest. And then, oh, by the way, we talked to one of the biggest investors who was a financial investor, a very well-known one, very blue chip brand. They were also okay with this because they understood that, yes, we were a leader and we continue to be a leader in the memory space. So it doesn't happen probably all that often, but it can happen. Syndicate tolerance, can actually be good or bad. I sort of already alluded to this, but you'll be surprised how different semiconductor companies can actually show up on the same cap table. But sometimes, like I mentioned, some companies don't like to be on the same cap table together. It just gets too awkward. That's a case-by-case thing that you just have to learn about as you go. And you can ask politely about that when you meet different CVCs, right? Terms, this is an interesting one. You have ROFR, right of first refusal, but you also have ROFIN, right of first notification. And we probably don't have time to go into all the details about this, but let me give you the quick version and you can just work with your counsel on this. Right of first refusal, probably not a good idea to agree to that term, but right of first notification, totally okay. Just think of it this way. If you take somebody's money and they're a corporate investor that could potentially buy your company, it might be a good idea to kind of tell them that, yeah, there may be a deal on the table. Maybe you guys want to put in a bid, right? If I was selling a company, I'd want as many bidders as possible around the table. Does not mean you need to tell them who else is bidding and all the gory details about it. But just think of it as like alerting people to, hey, something's going on. Maybe you might want in on this. And ultimately, it could be for the benefit of the entrepreneur by, supply and demand, pushing the price up. Regulatory issues, as I noted, they don't need to be deal killers. I think they can all be worked through, and it's nothing that should make you walk away from a deal. Just understand what they are and do what's appropriate. Commercial agreements, yeah, like I mentioned, they can be doable. It's really hard to generalize on them because they could be very lightweight. They could even be just a letter of intent that everybody agrees upon. Or they could be a full-blown, 30-page commercial agreement, or somewhere in between, or there's no commercial agreement at all. So just, again, ask about that up front. It's a case-by-case thing. I think they are doable. Ideally, you want to decouple that from investment, and there's different ways to define decouple. Maybe you could agree to trench out an investment as the commercial agreement develops over many months, because the downside of a commercial agreement is you're going to be heavily involved with the business units. They're not going to move as fast at startup speed. They're probably not even going to move as fast as the investment team's speed. And you don't want to delay your funding, right? So maybe you trench it out, maybe you push it back some way. There's different ways to do this. Finally, my last slide is, guide me into the unknown and across change, please. So perhaps this should have been the first or second slide, but what I'm trying to communicate here is, like I alluded to before, these corporations can be massive organizations, right? The company that I work for has over 300,000 employees and around 130 different offices and research centers. I sometimes don't even know how to call, this person in Germany or that person in Italy or this person in Korea. Like, yeah, we have a corporate database where I could look up people's names, but as you can imagine, I don't know 300,000 people in this company, right? It can be very murky, not translucent. Who is your guide? Who is your Sherpa? They should be your CVC, right? They literally should hold you by the hand, and I've done this many, many times over the years, and they should open your eyes and give you transparency to a world that was otherwise almost completely invisible. And I would argue that for international companies, this is even, of course, more difficult because of the language barriers and things I talked about before. So if you don't get the sense that your CBC is going to be your guide, your Sherpa from early on, maybe they're not a good fit for you. You know, I've literally sat in meetings with people from business units, and I have to, sometimes it's difficult, but I have to represent sort of, it's kind of hard to describe, but I've sort of had to represent what's appropriate when working with an entrepreneur. And then, of course, representing what my business units are interested in, right? Let me give you a more specific example. And this is maybe more relevant for deep tech companies, but there are often issues of IP, right? An entrepreneur should never fully reveal all of their IP to anybody. Perfectly okay to talk about publicly filed patents because they are by definition publicly filed, and the whole world basically has access to that. But when it comes to things like the secret sauce, you know, how do things really work? Is the innovation not so much patented, but basically, kind of secret know-how? I've literally been in meetings where a business unit engineer, only because they're a really good engineer, and a good engineer should always be curious. You know, there's probably engineers on this call. I know you're very curious and you want to know how things work. You know, who even cares what headquarters thinks? I just personally want to know what makes something tick, right? You know, I spent some time in computer science school, so, you know, I get curious like this as well. But I've literally had to intervene in real time in a growingly awkward situation where a very curious engineer was asking questions that were getting a little too detailed, you know, beyond the scope of what was publicly available in the patent. Think of it that way. And I basically had to shut him down, right? Real time in a meeting with like 10 people, with the entrepreneurs right there. But what I was doing was my job. Okay. I was being a Sherpa and a guide, actually, in this case, to both sides, right? That's another way to think about it. Will your CBC be your Sherpa for everybody involved? And I was reading the body language of the entrepreneurs, and I could tell they were getting really uncomfortable, and we were just going too deep. So, as you can see on various bullets on this slide, there is a way to talk about sensitive topics, even with your CBC, and even when business unit people are impressive or present. I would argue it's the best CBCs that are doing their jobs that are able to do this. And also, I would argue, if they do their jobs right, their business unit people should also understand this. They should also understand that the CBC is the guide, the Sherpa for everybody involved, right? It's actually, it can actually be one of the most fun parts of the job, to be honest, right? When I have very interesting technology and entrepreneurs, and I've got very curious business unit people, we can all make beautiful music together, right? But we all have to basically do our jobs. That's really about the open and polite communication, no matter what. Sometimes, and if I jump forward to the winds of change in the third bullet, and really at the end of the day, this is all about relationships. You know, the venture and startup industry, it's all about people, right? This is not about stock trading in publicly traded companies, and you may not know anybody at that company, right? The investors may not even care who they are, right? Other than what their track records are. They're not going to call, people on this call trade stocks, right? Do you know everybody on that team? Do you understand everything about their technology? And, do you have a personal connection to them? Yeah, probably no. Sometimes you invest in people, even if they're, big time publicly traded CEOs or whatever. But in the startup and venture land, it's really about relationships and people you trust. Because when you take money from people, they say it's almost like getting married, right? You're in it for nowadays 8 to 10 years, sometimes even more. It's a long-term relationship. So you always have to be polite. You have to try to be open, even if the winds of change are blowing. There's a whole bunch of bullet points on the right-hand side. I've touched many of them, but let me say it's good to be open, be honest, maintain those relationships, and what I call roll with the punches. The reality is corporates are changing all the time. And sometimes that influences change in their CVCs. I mean, we talked about it in the intros for my team. Many years ago, we used to invest across many, many different domains. Now, because we are very related to Samsung Semiconductor, we're very focused on looking for innovation in the world of semiconductor, right? Because we think it's very important. And so it's true that we're more narrow than we were before. But guess what? Our company is also very expert in the world of semiconductors. So it can be a win-win, even though now we're more narrow. That's what I call is the winds of change, right? We've just changed, and that's just the way it is. And the entrepreneur should roll with the punches on that, because guess what? Sometimes, like everything in the startup business, you already know this, things in the world, the winds blow in your favor, and sometimes they don't, right? But guess what? The winds also change. They may come back and blow in your favor once again. So, I have high hopes that someday we might be able to return to other domains. I was talking to people before the call started that many years ago, we used to invest in auto tech. Now I'm starting to see indications that we may actually return to that. So once again, the winds of change are blowing. Don't ever take it personally, and just, be a professional and maintain those relationships. And that concludes my slides for now. Victoria and John and team, do we want to do some Q&A here? Is there anything that anybody specifically wants to talk about? Just let me know.
Any of the startups have questions for Daniela? Go ahead.
Hi, how are you? Thank you very much for your extremely clear presentation.
Oh, thank you.
I have a very pressing question, and I'd love your experience for this, because I have this biotech company that's developing preventive treatments for infections to replace antibiotics. And we've been working with Abbott Laboratories for a while, and validating our technology with them. And now we're in talks with a corporate venture, with a big feed company. And also we are in terms in interviews with an accelerator, very specific about aquaculture. And they came to tell us that it's kind of a red flag to be involved with such huge partners. And because this corporate venture company might try to keep us, small and in the portfolio, and not be able, they said maybe they might want to sell you, I don't know, to buy you in a lower price, and not 40 million and 100 million. That's what the amount that we are expecting to. So how to flip, how could I answer to flip, this kind of red flag to something good?
So their concern was that the corporate would not allow you to scale up.
Yes, and maybe to do some kind of alliance or some kind of negotiation or something that could limit us, only to work with them, exclusive, some kind of exclusive deal or something.
Yeah. So I think the simple answer is they're wrong, because you're not going to do a bad deal with the big company and their CVC, right? You're not going to do a bad deal with anybody, right? So this kind of goes back to what I said earlier, which is market terms, like whatever agreement you end up doing with them. And of course, you're in another sort of world of deep tech, but just for the life sciences, right? The world you live in and the world I live in are full of patents and, intellectual property, all this kind of stuff, right? So by definition, I'm assuming you're already around, your counsel. Your attorneys should have really good guidance on, how are pharmaceutical deals, if you want to call it that, done between small startups and big giant companies, right? That term market, which is sort of, think of it as the average that is acceptable to most people that are reasonable, that market deal terms do exist in your industry. This is, I don't do biotech investing, so I don't know what they are, but you should work very closely with your counsel. And I'm assuming your counsel has done many, many different kinds of deals in this world. That's code for don't work with counsel that has no experience in this industry. That would be a bad idea. And by the way, I've seen this before when a startup has a bankruptcy attorney as their counsel. That does not typically end well, right? Or like somebody who does wills and trusts, right? It's like, no, you need a startup lawyer, right? So I would say, yeah, you're not going to do a bad deal. You message this with people that are criticizing this situation. So to be honest, sounds like to me the people that are giving you this criticism, they kind of sound like newbies. Like they should know this already. So maybe they are newbies. That's fine. There are lots of relatively new incubators out there, and there are lots of different kinds of startups. So not everybody knows about every detail of every single industry. So it's your opportunity to educate them, right? And what I would do is take that red flag, like you said, and turn it into a green flag. And it starts with, we're working with very sophisticated counsel. We are very sophisticated. We're not going to do a bad deal. And then give them ideas of the type of deal you would do. Like, for example, I mentioned ROFR. We would never agree to a ROFR. We would only agree to a ROFIN, right? Not first refusal, first notification. We're not going to do any kind of exclusive. And, you could lay out, basically, this is what makes a deal bad, and we're not going to do that, right? Now, here's the tough part. Given the macroeconomic change that started last year, remember how I said the pendulum may be swinging to more investor friendly? Now, here's the hard part. You need to have enough potential investors. And by the way, this applies to everybody on the call, not just this situation. You need to have enough potential investors lined up who want to get around the table so you don't do a bad deal. The reality is, in tough economic environments, sometimes people have no choice but to do a bad deal, right? So that's the tough part. The tough part is not trying to convince somebody who really doesn't understand and you have to educate them. I kind of think that's the easy part. The tough part is trying to get more money around the table. And by the way, you also brought up something in a way that I forgot to mention when I was talking about board participation. I probably should have put this on the level up, which is, for them to argue like, they're going to buy you at a low price or something. Well, how would that be possible? Because you're going to have a board of directors, and ideally, you're going to have a diversity of opinions. You're going to have financial investors, and you're going to have corporate investors. You may even have some corporate investors that frankly compete with each other. And guess what? When they're all arguing on what is the sales price of this company, guess what? They all, even if the one that this person or incubator thinks you're going to get a bad deal with, what do you think is going to happen if they're on the board and they're trying to undercut you on price? How do you think the other board members are going to react to that, who have a legal right to vote, particularly the financial VCs who want to see a higher price? So does this incubator think you'll be in a situation where you don't even have a board? I'm assuming you're going to go through seed funding, then Series A, maybe Series B. And again, I'm not a biotech expert. I don't know at what stage do different biotech startups get acquired. I think it's probably typically earlier than, say, a SaaS company. But I would assume that I would advocate that even at the seed level, you need to start creating a board. And then by the time you're at Series A, you should have a professionally run, very good board in the ideal world. And there's going to be multiple voices, and anybody who's acting out of line, in a sense, they're free to argue their case in front of the board, just like everybody else.
Thank you very much. It's been great. I'll remember. I'm writing down.
Sure. Yeah, the whole thing just seems odd to me because I've got a funny feeling you need to educate somebody here because they really don't understand.
I have a follow-on meeting next week, so I'll bring that up. Thank you.
Excellent. Good luck.
Any other? We probably have time for one more question. And if not, I'll just briefly extend on that last discussion that that incubator may be newbies, but I do think there is also a minority view, you don't hear a lot, but continuously, that somehow financial VCs are clean money and corporates are CVC is sort of corporate vulture, that, you know, whether it's Verizon or John Deere, whoever, that they just want to suck all that information out of you and then make it themselves. And some people are just, I think, have an antipathy to that, which is unfortunate.
Yeah, I've actually had direct experience with that, right? Particularly in the world of, again, deep tech, where there's a lot of IP and patents, and and then if you cross-reference with what I said before, a lot of the international CVCs and companies they're not very transparent for the variety of reasons I mentioned. So I've had a semiconductor company, for example, that I cold called after I did some market research, and I thought that they might be a good fit as an investment target. They had never talked to my parent company because of those reasons, John. But guess what happened? I called them up. They quickly realized that I was based in Silicon Valley, that I'm a professional investor. And think about it this way at the end of the day. The professional investors, and by the way, corporate venture capital has very much professionalized over the last, even since I started in the last, 10, 12 years. 20 years ago, CVC was maybe a different animal. I won't even go into the details around that. But nowadays, you're actually seeing a lot of CVC teams, like I described with the team I'm on. You're seeing a lot of private VCs that have actually transitioned to CVC, and they therefore run the team sort of like a private VC, which means in a way it's very nuanced, but think of it as just professionally. And, I frankly told these entrepreneurs that were also in Silicon Valley, look, I'm your Sherpa, I'm your guide, just as I described on my slide. If I burn you guys in any way, shape, or form, how long do you think my career in Silicon Valley will last? We're in a very small community, and there's Twitter, there's LinkedIn, there's other social media. If this is some sort of raid on your IP, and oh, by the way, can anybody point to any startup that truly thinks that, they were destroyed because somebody stole their IP? Please send me that article. I'd love to read it because I haven't really found one. And pretty soon these guys realize, oh, you're a Silicon Valley insider. You're basically one of us. You've worked in startups before. I even worked on my own startup many years ago. Turned out I wasn't the best entrepreneur, but turns out I'd like to think I'm a pretty good CVC. But I'm a member of the community just like you are. I have no reason to do that, right? And like I described before, my job is to also guide the mothership, the business units, to also act in a professional and appropriate manner. And if you have any problems on communicating with anybody who you think is going too far, come talk to me about it. We'll work it out. That's kind of part of my job, right? Hope that helps.
Oh,
Thank you
absolutely.
very
I was
much.
just going to say thank you so much, JC. You're always sharp. You're always on point. You know the space really well. I have seen the evolution of CVCs, and they do come in different flavors.
Yes.
So thank you for bringing in your expertise, especially having worked at Samsung Catalyst Fund, and you're seeing things that are very, very global, like you said, very large TAM opportunities. So thank you again. Be an early supporter of Extreme Tech Challenge and bring your time and expertise to our entrepreneurs.
Oh, thank you. It's been a pleasure, and good luck to everybody.
And I'll just mention JC's LinkedIn is in your chat if you haven't seen that. Victoria put that there. And I will just quickly mention what we have coming up tomorrow is, again, a mix of these topics, talking about marketing your company with Fergus Hay, another discussion about raising finance with an interesting combination of a Singaporean investor and a partner in the new Amazon Climate Pledge Fund. Dennis Leo will be back to also talk about corporate fundraising. And then Friday, another discussion of branding with our own XTC communications folks, Beep. And then finally, a town hall that I'll be hosting with 3 of our XTC finalists and alumni who've been very successful at growing their business and raising funding. So please join us for those. And again, if you have a chance to scan this QR code, this is for the complete agenda. And to remind people that the recordings of these will be on our YouTube Bootcamp channel in a few days, and at most by next week. And with that, I think we are done.